All right, welcome everyone. It is my pleasure to introduce you to today's speaker, Ruthanne Monteleone. Ruthanne is a certified financial planner and has over 10 years of industry experience. In addition to her CFP designation, Ruthanne carries her Series 7, 63, and 65 licenses and is life, accident, and health licensed in multiple states. As a graduate of the Hill School and Westchester University, Ruthanne has spent the last 20 years in the Chester County area. Ruthanne works out of the Citadel's Chester Springs, Eagle, and Phoenixville offices, but also offers virtual meetings for those residing outside of her area. Ruthanne's approach to financial planning is more than just investment management. Although the relationship begins with a solid investment plan, Ruthanne incorporates all aspects of your personal life and financial life into your comprehensive and evolving financial plan. Her process focuses on consistent communication, explanation, and education. Today, Ruthanne will be sharing with you some key challenges women moving into retirement face and some strategies to overcome them. Before we get started, I just wanted to let you know there will be a Q&A session after the presentation. You can post questions at any point during the presentation and the Q&A session in the Q&A chat box in the bottom right corner of your screen. Also, when you leave the webinar, a short survey will appear. Please let us know how we did. Once you complete that survey, you will be forwarded to a screen where you can submit a consultation request with one of our advisors. With that, I'll hand things over to Ruthanne.
Hi, everyone. Thank you so much for taking time out of your day to attend the webinar. We are having some technical difficulties, surprise, surprise, even in this post-COVID world. We still haven't mastered technology and remote webinars. So we're having some issues getting my camera to work so all of you can see me, as well as we're making sure that we can have the presentation up for you all to view. Scott, before we move forward, can we just confirm that everyone is able to view the presentation before I get started?
Yes, we did get a confirmation that everyone can view the presentation right now.
All right, great. Well, thank you very much for that, and thanks again. So I'm going to run through this presentation of retirement savings challenges for women. It's a very high-level presentation that's kind of applicable to everyone. I do implore you to kind of save your questions for the end. If we see any questions coming throughout the presentation for clarification on anything, they'll get passed along to me, but really save your questions for the end. And then I ask you to reserve any questions that are really specific for you. Just reserve those for a one-on-one meeting that we can have, or shoot me a one-off email, or give me a call, and just try to share your questions that you might feel general to everyone or might provide clarification. I do want to kind of spend about 20-25 minutes on the presentation and leave plenty of time for you to ask questions, because I feel like the one-on-one and the ad hoc or even the Q&A can be just as beneficial, if not more beneficial, than a high-level overview of this presentation. So I'm going to go ahead and get started. When it comes to saving for retirement and planning for retirement income, women face a number of unique challenges, which we'll be discussing in more detail. First of all, women generally live longer than men, which means they may need to plan for more years in retirement. Because their longer life expectancies, women should also consider that they may spend some of their retirement years living on their own. Women often interrupt their careers and care for children and aging parents. Because of these career interruptions, women may spend less time in the workforce and earn less money than men in the same age group, which could result in saving less for retirement and having lower Social Security benefit. It's important to recognize these challenges and plan accordingly. And before we look at each a little bit more closely, I just want to share a little personal information about myself. So I actually delayed my career being a single mom right out of college. So this is something that's near and dear to my heart, not only from that aspect, but also I'm now in a situation with one working parent where my husband now is taking time out of his career to care for our young children. So we're kind of on the opposite side of planning here. So this is not only applicable to women. There are lots of changes now going on in the workforce where more and more women are working and more men are staying home. However, if you go over to the pool and my husband's there in the afternoon, it may not seem like the case, as he's the only dad sticking around. All right, let's move on. So women are living longer than men. Statistically speaking, and all other things being equal, you're likely to live longer than a man your age. Women on average live about 6 years longer than men. That in of itself isn't a bad thing, but that just means you need to plan for more years in retirement. The bottom line is, don't underestimate the number of years you may spend in retirement. There is a challenge that women have a higher likelihood of living in their own retirement and living on their own. According to recent statistics, older women are much less likely to be married than older men. About 47% of women are married compared to 69% of men. In addition, 30% of women age 65 and older are widowed and 17% are divorced. Among women age 75 and older, 43% of them live alone. For married women, the loss of a spouse could mean a reduction in retirement income from Social Security and/or pensions. Women are also more likely to take time out of the workforce to raise children and care for aging parents. Sometimes this is by chance and sometimes it's by choice. But moving in and out of the workforce has several significant financial implications for women. First off, loss of income and employer benefits, such as retirement benefits and health insurance. Lost income means potentially lower savings. Potentially lower Social Security retirement benefit is another potential issue. This is because your benefit is based on the number of years you've worked and the amount that you've earned. Economic vulnerability in the event of a divorce or spouse's job loss can also affect you. You may possibly have a more difficult time finding a job comparable to a job in comparable pay and benefits when you're trying to return to the workforce after taking time off. Even women who do remain in the workforce are much more likely to request flexible work schedules to meet primary caregiving responsibilities, which can affect their salaries and long-term career advancement. Overall, women generally earn less than men. According to the Bureau of Labor Statistics, women who work full-time earn, on average, about 83% of what men earn. This wage gap can affect overall savings, Social Security retirement benefits, and, for those lucky enough to have one, a pension. It also means women are more vulnerable to unexpected economic obstacles such as job loss, divorce, single parenthood, illness, or the loss of a spouse. So the question is, how much annual income will you need? Because of these special challenges, planning for retirement is especially important for women. So where do you start? The first step, I say, is to ask yourself, how much annual income will I need? It's often stated you should plan on needing 60 to 90% of your pre-retirement income when you retire. The appeal to this approach lies in its simplicity, but general guidelines like this aren't always very helpful because they don't really take into account your individual circumstances, expectations, and goals. It's fine to use a percentage of your current income as a benchmark, but really I think it's more important to focus on your current expenses and really think about how those expenses are going to change over time as you transition into a retirement. For example, let's think about your mortgage and the cost of commuting to and from work. That may disappear during retirement, but other expenses may increase, like yard care services, snow removal, home maintenance, things that you take care of by yourself right now, but when you move into retirement, you may not want to, or you might not be able to anymore. And if you're using your newfound free time to travel more, one, you're not going to be taking care of that yard work, and two, you may have increased expenses by traveling or picking up new hobbies in retirement when you have more time. I always say when you have more time, it's likely you're going to spend some more money. Though it may be difficult to try to list all of your expenses and project how much you'll be spending in each area when you retire, I really implore you to try to do so. It at least gives us a basis to get things started. Something else we need to do is account for inflation. It's something that I do as a financial advisor on a regular basis that you may not think about all the time. When you estimate your projected expenses in retirement, you can't assume things will cost the same as they do today. You also need to consider the potential impact of inflation on those expenses. This is a really hot topic right now, coming off of 2022 and moving into 23 here and later 23. But generally speaking, inflation is the risk that the purchasing power of a dollar will decline over time due to the rising costs of goods and services around us. Inflation is often overlooked when planning for retirement, but unless you take it into account, you may underestimate the amount of annual income you'll actually need in retirement. If inflation runs at its historical long-term average of about 3%, a given sum of money would lose more than half of its purchasing power over a 25-year period. For example, assuming a 3% inflation rate, a gallon of milk that costs $4 today would cost you $8.38 in 25 years. All other things being equal, inflation means that you'll need more retirement income each year just to keep pace. To outpace inflation, you should try to have a strategy in place that allows your income stream to grow throughout retirement. Another thing that we need to think about, and I think about all the time, is taxes. Like inflation, taxes are another important but often overlooked aspect of retirement income planning. Taxes can eat into your income, significantly reducing the amount you have available to spend in retirement. You want to make sure you understand whether the income you're counting on is or is not subject to tax. For example, private pensions are generally fully taxable. You might be surprised to learn that a portion of your Social Security retirement benefit may also be taxable depending on your filing status and total annual income. Keep in mind that some income, like interest, is taxed at ordinary income tax rates. Other income, like long-term capital gains and qualifying dividends, currently benefit from special, generally lower, maximum tax rates. And some specific investments, like certain municipal bonds, generate income that can be exempt from federal tax and sometimes from state tax as well. You all with me? You awake? Have a sip of coffee. I know taxes can be tough, but they're really important, so stick with me here. You should also understand how distributions from tax advantage accounts like traditional IRAs and 401ks are generally taxed. Generally, distributions from these accounts are taxed as ordinary income, regardless of whether investments within the account have generated long-term capital gains or dividends. Special rules do apply to Roth IRAs, Roth 401ks, Roth 403bs, and Roth 457bs. Qualified distributions from these accounts, which are funded with after-tax dollars, are free of federal income tax. Now we're going to talk about some municipal bond tax. So stick with me here. This can be a lot, but just remember, these are things that if you don't know, you should seek a financial professional or a tax professional's advice to help you with. I'm not, giving you this information to scare you, but it can be overwhelming. So a lot of times people think things are simple and there's a lot more that's involved. So just remember that if you don't understand these sort of things, seek someone out who does. And I always recommend a professional. So here we go. If you sell a municipal bond at a profit, you could incur capital gains taxes. The principal value of the bonds may fluctuate with market conditions. Bonds redeemed prior to maturity may be worth more or less than their original cost. Some municipal bond interest could be subject to the alternative minimum tax. You may know it as AMT. Bond funds are subject to the same inflation, interest rate, and credit risks associated with their underlying bonds. As interest rates rise, bond prices typically fall, which can adversely affect the bond fund performance. And we saw that more than ever last year with the rapid rise in interest rates. Mutual funds are sold by prospectus. Money market funds are neither insured nor guaranteed by the FDIC or any other government agency. Although money market funds seek to preserve the value of your investment at $1 per share, it's possible to lose money by investing in such a fund. Be sure to read the official statement and prospectus, which contains information about the investment options, underlying investments, and the investment company, and can be obtained from your financial professional. Consider the investment objectives, risks, charges, and expenses carefully before investing. All right, so healthcare. Here, a big buzzword here, and healthcare costs in retirement. So when you're calculating how much retirement income you'll need, one of the most important expenses you need to consider is healthcare. Not only does a longer life expectancy mean more retirement years to plan for, but also it means you will likely spend more on health care for premiums and uninsured expenses. For a married couple, there is a risk that savings may be depleted by healthcare costs relating to the passing of the first spouse, reducing the amount available to the surviving spouse. As we know statistically, that could be you as a female. In addition to general health care premiums and expenses, many women will have a need for long-term care because they are more likely to be living on their own in later years. Long-term care refers to the ongoing services and support needed by people suffering from chronic health conditions or disabilities. Currently, the nationwide average monthly cost of a private room in a nursing home is just over $9,000 at $9,034. But if you don't need the highest level of skilled care, there are other less expensive options, including assisted living facilities, adult daycare centers, and even home health aides, which is actually another job that I did in college. Many people assume that Medicaid will pay for long-term care costs. You may be able to rely on Medicaid, but there's a catch. To qualify, your assets and income must be low enough for you to qualify. You have to use up most of your savings before you even qualify for Medicaid and set aside small personal needs allowance. You'll have to use all of your retirement income, including Social Security and any pension payments, to pay for your care before Medicaid pays a dime. Another option to consider is long-term care insurance, which may provide a source of funds for long-term care expenses, but doesn't necessarily ensure that you won't have to pay for some of those costs out of pocket. And the premium for this insurance definitely needs to be factored into your retirement income needs. So then the next question is, how long will retirement last? We've talked about how much retirement income you'll need, but we really need to discuss how long you're going to need that income to last. When it comes to your retirement, how long of a period should you plan for? The good news is we're living longer lives. The bad news is that generally means your retirement income will need to last for a longer period of time. As I mentioned earlier, the average 65-year-old woman in the U.S. can expect to live about another 20 years. As life expectancy continues to increase and has increased at a steady pace over the last years, it's likely to continue to increase. So it's not unreasonable to plan for a retirement that lasts for 25 years or more, which means your income and savings will need to last that long as well. So the question is then, where will your retirement income come from? Traditionally, retirement income has been described as a three-legged stool composed of Social Security retirement benefits, a traditional employer pension income, if you're lucky enough, and individual savings and investments. The first two legs of the stool, Social Security retirement benefits and employer pensions, produce a steady or relatively fixed income stream that you can depend on during retirement. So let's drill into Social Security a little bit more. Today, 94% of U.S. workers are covered by Social Security. Social Security is the major source of guaranteed lifetime retirement income for most Americans. For some women, Social Security makes up most, if not all, of the income that they'll have in their later years. That's really scary to me. And we'll look at some numbers a little bit later, but you know, that statistic should stick out to you and really sticks out to me. To qualify for Social Security retirement benefits, you have to work in a job that's covered by Social Security, and you generally need to have earned 40 credits, which is about 10 years of work. If you haven't worked long enough to qualify for benefits on your own, you may qualify for spousal benefits based on your spouse's work record. A spousal benefit claimed at your full retirement age is generally equal to 50% of the primary earner's benefit. Now, the next question is, how much can you expect from Social Security? The amount you'll receive from Social Security is based on the number of years you've worked and the amount you've earned. Your benefits calculating using a formula that takes into account your highest 35 earning years, not your most recent, but your 35 highest. If you earned little or nothing in several of those years, it may be to your advantage to work as long as possible because you'll have the opportunity to replace a year of lower earning years with a year of higher earnings, potentially resulting in a higher retirement benefit. Another plus is that Social Security's annual cost of living increase, or COLA, are calculated using your initial year's benefits as a base. The higher the base, the higher your increase, right? A percent increase of a higher number is a higher number, which is something that can help you maintain your standard of living throughout many years of retirement. Also, keep in mind that if you're married and your lifetime earnings were lower than your spouse's, You may be eligible for a spousal benefit based on your spouse's earning records and if it's higher than your own worker benefit, you may be able to collect. An unmarried divorced spouse who's been married for at least 10 years may also be eligible for a spousal benefit. The age at which you start claiming benefits, which is a huge question I get all the time, that's really going to affect the amount you receive. You can choose to start taking retirement benefits as early as 62, but if you do so, your monthly benefit will be 25 to 30% less than if you had waited until your full retirement age, which is 66 or 67 or somewhere in between, depending on the year you were born. On the other hand, you'll receive a higher monthly benefit if you delay claiming Social Security benefits until the maximum age of 70. If you wait that long, your monthly benefit will increase by 8% for each year that you delay taking your benefits past your full retirement age. I'm going to say that again. So every year you wait past your full retirement age, and every year you delay, you get an 8% bump or increase in your Social Security benefit. Of course, even if you claim benefits at age 62 and receive a smaller monthly benefit, you'll receive them for a longer period of time, or you'll get more benefit checks, right? So for example, if your normal retirement age is 66, opting to receive benefits at 62 means you'll receive 48 additional monthly benefit payments. So that's when you need to work with a financial professional like myself or one of our CFS advisors here at Citadel, and we can kind of help you figure out, based on a number of factors, the optimal time for you to potentially collect your Social Security. So this chart here illustrates what a hypothetical person might receive by claiming Social Security benefits at different ages. It's based on a full retirement age of 66 and a benefit of $1,800 per month. As you can see, if you start taking benefits at age 62, you would receive $1,350 per month. But if you delay and wait until age 70, you would receive $2,376 per month, which is about $1,000 more per month. Remember, this monthly benefit is guaranteed every month for as long as you live. So an important question as you approach your 60s is, should you begin taking Social Security benefit as early as 62 and receive smaller payments, but possibly receive them over a longer period of time? Or should you wait until your full retirement age, which a lot of people do, or start taking benefits and receive larger payments over a shorter period of time and take them later, right? There's no right answer. There's no perfect answer. This is definitely an individual decision that has to be based on a ton of factors, like your other sources of retirement income, your life expectancy, your health, your marital status, whether you plan on continuing working after you take benefits, and taxes. The bottom line, though, is that for most women, Social Security alone isn't going to provide enough income in retirement. All right, so I'm going to move on from Social Security. We're going to talk about some pensions. If you or your spouse is entitled to receive a traditional employer pension, you're really lucky. Fewer and fewer Americans each year are covered by these plans. Pension benefits can be complicated, so it's really important to understand how they work. I'm going to talk you through some different scenarios with pensions, but once again, I recommend that you get if you are lucky enough to receive a pension or have the ability to receive one in the future, get this printout and get your pension estimates from your employer and work with a professional to figure out what option is best for you. But I'm going to kind of explain how each option works. A typical pension benefit is payable monthly over the plan participant's lifetime, starting at their normal retirement age. And that normal retirement age is typically dictated by the employer. So let's use age 65. This is called a single life annuity. However, once the plan participant dies, the benefit payments end, even if only a single payment has been made, right? So you start collecting at 66 or 65, 2 months go by, you've collected 2 pension checks, and you pass away, the pension ends. So you've put in 40 years of hard work, and that's it. If you're married, federal law requires that benefits are paid as what's called a qualified joint and survivor annuity, or QJSA, unless both you and your spouse agree and sign off on receiving the benefit as a single life annuity or in some other form, right? So sometimes you get a piece of paper for your spouse's pension, you go through the options, and you sign, and you're signing away your right to a survivor benefit. So you really need to pay attention to what you're doing, because the qualified survivor benefit pays a monthly benefit to the plan participant and continues to pay, and I'm going to use the example of 50% to the surviving spouse. The amount paid to the participant during his or her lifetime is generally smaller to get that survivor benefit because it's payable over a potentially longer period of times. You're insuring, or they're insuring, 2 lifetimes instead of 1. So if you're entitled to a pension, your choice of whether to receive the pension benefit as a qualified joint survivor annuity or in some other form may be one of the most important retirement decisions you'll ever make. And once you make that decision, it can't be changed. So let's look at an example. These numbers are purely for illustration and aren't meant to reflect the exact benefits in any particular plan. Suppose your spouse retires at age 65, having earned a pension benefit of $4,000 a month, payable for your spouse's lifetime. This is his or her single life annuity benefit. Because your spouse is married, however, the pension benefit must be paid as a qualified joint survivor annuity, unless you both agree to choose the benefit in a different form. Because the qualified survivor annuity is paid over a longer period of time, both of your lifetimes, right, the amount paid to your spouse when your spouse is alive is reduced. Let's assume that under the survivor annuity, your spouse will receive $3,800 each month, and after your spouse's death, you'll receive a 50% survivor amount, or $1,900 per month. This is called a 50% qualified joint survivor annuity. You may also have the option to receive up to 100% of the amount your spouse was receiving during your spouse's lifetime. In this case, because your survivor benefit is higher, your spouse's benefit is reduced yet again. Let's assume in this instance that your spouse's monthly benefit under the qualified joint survivor annuity will be $3,600 during your spouse's lifetime, and that you'll receive the same amount, $3,600, after your spouse's death. This is called a 100% qualified joint survivor annuity. You may be tempted to take the single lifetime annuity because it provides the highest monthly benefit now, but this option would provide no benefit to you once your spouse dies. Waiving this qualified joint survivor annuity and taking the single life annuity should be considered really, really carefully. All right, so we've talked about Social Security and we've talked about pensions. So let's recap for a minute here. And we've also talked about estimating how much annual income you'll need in retirement. So if we compare these two, we're going to find a gap, right? We've got our guaranteed income sources of Social Security and pension if you're lucky enough. We figured out how much income that we need, and the difference is the gap, right? That's where the third leg of the stool comes into play, and that's your own personal savings and investments. When we're talking about personal savings, we're talking about funds that you have in tax advantage accounts like IRAs, 401k plans, 457B plans, and 403B plans, as well as investments you hold outside of tax advantaged accounts. Now, personal savings, we've already explained that women face a number of challenges, right? Statistically, women earn less than men in similar jobs and we're more likely to work part-time. We also tend to spend fewer years in the workforce, primarily due to caregiving responsibilities. Compounding the problem is that women often start saving later and saving less than men, which can reduce our chances of having enough income in retirement. The combination of these factors means we may not have enough savings in retirement unless we plan properly. These factors explain why many women are at a disadvantage when it comes to saving for retirement, which makes it vital that we take the right steps to identify and address any projected shortfall. So what can we do, right? With all the challenges that we as women face, we need to start by stating the obvious. The number one thing is to start saving now. Set a savings goal that you can work toward and keep track of your progress. Monitor your investments and make changes as needed. A financial professional like me can help you with this. If your employer offers a retirement savings plan like a 401k or 403b, start contributing as much as you possibly can. If you're contributing the maximum amount your employer retirement plan to your employer plan and you need additional options, or if your employer doesn't offer a retirement plan or you're not currently working, consider an IRA. We'll talk more about this in a second. The next thing you can do is become a knowledgeable investor. Some of you here today may have handled your family's finances all along, while others might be new to the world of investing. No matter what your level of expertise, there's always room to learn more and adjust your plan based on your current circumstances. Because many women will end up being solely responsible for their own financial well-being at some point in their lives, it's important that we have sound understanding of the investment world and the confidence to make appropriate investing decisions. So here's an example of how saving a little extra each month can mean a lot during your retirement years. Assume that Jane and Sally both earn $50,000 a year from their jobs. Jane saves 5% of her salary each month, while Sally saves 8% a month. After 15 years, Jane will have saved $37,500, and Sally will have saved $60,000, roughly $22,500 more, just by saving 3% difference a year. If Jane and Sally both earn 5% per year on their savings, Jane's savings will be worth $55,684 in 15 years, but Sally's would be worth over $89,000 at $89,095, which is more than $33,000 more, once again, just by saving an extra 3%. A little tip that I like to give is often your employers offer, or your employer-sponsored plans offer, an annual increase program where you can set it and forget it, and you go in and say, okay, I want to contribute 5% this year and set an auto increase for January for it to increase by 1% or 2%. And often that coincides when you may get a raise. So you're not going to notice the difference in your paycheck of a few dollars, but as you can see, that compound interest over time can make a huge difference. Now let's talk about some tax advantage savings vehicles, right? We'll talk more about these employer plans and IRAs. Probably the best way to accumulate funds for retirement is to take advantage of these special tax-deferred retirement savings accounts. A 401k plan and other employer-sponsored retirement plans can be very powerful savings tools because when your contributions come out of your salary on a pre-tax basis, they reduce your current taxable income and they accumulate tax-deferred until withdrawn. As a reminder, withdrawals made prior to age 59.5 can be subject to an additional 10% penalty. Having your contributions deducted directly from your paycheck can make it so much easier to sock away money versus saving what you have left over at the end of the month. It may be hard initially to receive a smaller paycheck, but paying yourself first should ultimately benefit you in the long run, and many employers match a portion of the amount you contribute as well. If your 401k plan offers a Roth option, you may be able to contribute to the Roth account. Roth after-tax contributions don't provide you with an immediate tax savings, but they allow you to make withdrawals free of federal income tax under certain circumstances. Finally, 401k plans often include employer matching contributions, which would make them your first choice in saving for retirement. You should try to contribute at least enough to receive the full employer match because realistically, it's free money. Traditional Roth and spousal IRAs can also be used to save for retirement and offer tax advantages. Traditional IRAs like 401ks feature tax-deferred earnings growth and can lower your current taxable income if you qualify, big asterisk here, to make tax-deductible contributions. Like the case with the 401k, funds aren't taxed until they're withdrawn, although they may be subject to a 10% penalty tax if withdrawn before age 59.5. Like Roth 401ks, Roth IRAs don't permit tax-deductible contributions, but they allow you to make tax-free withdrawals under certain conditions. Both 401k plans and IRAs enable you to make catch-up contributions once you reach age 50. IRAs and 401k plans are subject to annual contribution limits. Now for 2023, in a 401k, if you're under age 50, right now the annual contribution limit is $22,500. If you're over, or if you're age 50 or above, that contribution limit is $30,000. So when you think you're maxing out your 401k, if you're just maxing out that match of, let's say your employer matches 5%, and you're doing 5%, you think you're maxing it out, you can actually contribute up to $22,500 or $30,000 if you're over age 50. So just keep that in mind. The contribution limits for IRAs for 2023 are $6,500 a year and $7,500 if you're over age 50. All right, so let's deal with the shortfall, right? What do you do if you discover, after factoring in all your personal savings, that your projected income still won't meet your projected expenses in retirement? The best solution for dealing with a shortfall will depend on the severity of your projected deficit, the length of time remaining before retirement, and how long you need your retirement income to last. But consider one or more of these 4 options. You can spend less during retirement, you can delay retirement, you can work during retirement, or you can find other potential sources of retirement income. Let's talk through a couple of these options. All right, so delaying retirement. As you might expect, delaying retirement offers certain advantages when it comes to retirement income planning. The longer you work, the longer you'll be able to continue contributing to your retirement savings, right? Even if you're no longer adding to your retirement savings, delaying retirement postpones the date when you'll need to start withdrawing from your savings, and a shorter distribution period could significantly enhance the potential for your savings to last throughout your lifetime. As we discussed earlier, delaying retirement may mean you can postpone claiming Social Security retirement benefits, potentially increasing your annual benefit when you do begin taking payments. Continued employment may also result in continued access to company-sponsored health insurance. Of course, there could be some advantages if you plan to continue working in some capacity during retirement as well. The obvious advantage is that you'll be earning money and relying less on your retirement savings, leaving more of your savings to potentially grow for the future and helping stretch your personal savings. In addition, full or part-time work during retirement could potentially provide access to affordable health care. Many employers are offering health benefits to part-time employees as well as full-time employees. If you want to work during retirement, you will want to make sure that you understand how the income you earn might affect your Social Security benefit. While your earnings may increase your Social Security retirement benefit in future years, current benefits can be reduced. For example, in the years before you reach full retirement age, if you're collecting Social Security and working, 1% in Social Security, $1 in Social Security retirement benefits will generally be withheld for every $2 you earn over the annual earnings limit, which is $21,240 in 2023. There are also some special rules that apply in the year that you reach full retirement age. So let's say you're working and you reach full retirement age in May. In the months January through May, when you start collecting your benefit at full retirement age, there's a limit to how much you can earn during those years or those months as well. Now the limit's higher than the $21,240, but it is something that you have to be cautious of. It's worth nothing that a number of non-financial reasons may motivate individuals to work in retirement. I'm sorry, it's worth noting, not worth nothing. I can read, right? So it is worth noting that there are reasons to continue to work, right? You may value the social interaction. You may have a sense of accomplishment and structure that your career provides that, gives you joy. And ultimately, you decide that full or part-time work and launching a new career and starting your own business in retirement is the right decision for you. Or maybe you just can't stand to be home with your spouse all the time. It doesn't mean that that's a bad decision. One last observation on this topic. If you're working for an employer that offers a traditional pension, determine whether working part-time will affect your benefits. If your benefit is based on your final average pay, it's possible that working part-time could reduce your benefit. It could also be worth inquiring about any phased-out retirement program that your employer might offer. These programs may allow you to receive all or part of your pension benefit while you continue to work on a part-time basis. All right, so what are some other potential sources of retirement income? For example, if you've built up substantial home equity, which many of us have in the current environment, it's possible that you could tap into that equity as a source of retirement income, either by selling your home and possibly downsizing, or by borrowing against the value of the home, a course that should be explored with extreme caution. Here's another example. An existing permanent life insurance policy that has accumulated cash value can sometimes be used as a source of retirement income. Although policy loans and withdrawals can reduce the cash value, reduce or eliminate the death benefit of the policy, and have negative tax consequences. So again, proceed with caution here. I'm going to dig into life insurance a little bit. This can get a little bit confusing, but this is our last topic, so I'm going to leave you with this information on life insurance, and then we'll open up things up to question and answer shortly. So permanent life insurance offers lifetime protection and a guaranteed death benefit as long as you keep the policy in force by paying the premiums. A portion of the permanent life insurance premium goes into a cash value account, which accumulates on a tax-deferred basis throughout the life of the policy. Withdrawals of the accumulated cash value up to the amount of the premiums paid are not subject to income tax. Loans are also free of income tax as long as they're repaid. But loans and withdrawals from a permanent life insurance policy will reduce the policy's cash value and death benefit and could increase the chance that the policy will lapse and may result in a tax liability if the policy terminates before the death of the insured, right? So if the policy ends before whoever's, presumably your own life, before you pass away, it can create some big tax consequences. Additionally, out-of-pocket payments may be needed if actual dividends or investment returns decrease, if you withdraw the policy cash values, or if the current charges increase. Any guarantees are contingent upon the claim-paying ability and the financial strength of the issuing company. So as with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges, and if it's surrendered prematurely, there may also be surrender charges and income tax implications. The cost and availability of life insurance depends on a number of factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it'd be prudent to make sure that you are insurable. All right, so with that kind of concludes the presentation today. I ask if you'd like to write down all of my contact information, my phone number. I have my office number here and my cell phone number, my email address. Email is a great way to reach me throughout the day as I can get back to you quickly between meetings, but you can always call my office or my cell phone and leave a message. If you'd like to schedule an appointment, there will be an opportunity to put in a request to schedule an appointment, or you can email or call me directly. And with that, I'm going to open things up to the Q&A. Let's see. So I see one here. How many hours can you work per month after collecting Social Security benefit at 62 without penalty? So it doesn't have to do with hours. It has to do with the amount that you earn. So there is that earnings limit of right around $21,000 per year that you can earn and collect before full retirement age, after the age of 62, if you are collecting your benefits. And this follow-up question to that is it true that in 2035 Social Security benefits will reduce $790 for every $1,000 of benefit? I would have to research that to see if it's true offhand, but I do not believe that has been approved as of yet. Another question is, will we get a recording of today's session? So this session has been recorded. The process is that it goes through review for compliance to make sure that I didn't say anything that I wasn't supposed to. And then it will get posted on Citadel's website for public access for you or for anyone that was unable to attend the event. You can share the link that will be on our website with them as well. Any other questions? And there's a Q&A box in the bottom right-hand corner of your screen. If you click on that, you can bring up that Q&A box and type a question in there that I'll be able to hopefully answer for you. Let's see. Can you talk a little about when exactly you can retire? For example, if I reach 67 in November of 2025, when is the year I can begin Social Security? So this is a common misconception or a common question that I get is, many people think that when they retire and when they can collect Social Security is the same date. That is certainly not the case. You can retire at 62 from working, but wait to collect your retirement benefit until age 70 if you want to. And with some of my clients, that's part of our plan, right? That we stop working, maybe we spend down some cash, and we do Roth conversions over the following 8 years while they're in a low tax bracket, right? So when you collect Social Security and when you retire, don't have to be the same thing. So if you reach 67 in November of 2025, you can start your Social Security in November of 2025, or you can start in January of 2026. You have to be careful about how much you've earned between January and November. So if you're reaching full retirement age at the end of the year, you have to be careful about how much you earned throughout that year. Right now, the limit's right around $56,500 that you can earn in a year that you are turning full retirement age and collecting without your benefits being reduced. So a lot of times when I have clients that turn full retirement age near the end of the year, if they're over that limit, we wait until January of the following year to actually start their benefit. They get a couple months of roll-up on their benefit, so it's a little bit higher, and then we don't have to worry about any reduction to their Social Security benefit. Great question. Any other questions? So it seems like a lot of these questions are Social Security related of what's coming in here. So I would say, if you have questions regarding Social Security, I implore you to set up a meeting with myself or with one of our other CFS financial advisors here at Citadel. We all have a lot of knowledge about Social Security and incorporating it into your financial plan, so we can help you select the best time or what we feel is a smart time for you to collect Social Security based on your taxes, your other income, your retirement needs, your health, longevity, you know, a lot of these other factors. So schedule an appointment with one of us and we can help you figure that out. All right, so if I receive a pension but I'm divorced, I should receive the full pension amount, correct? So the amount of pension, and I'm not sure if this is your pension or your spouse's pension, what this is, there is what's called a quadro, a qualified domestic relationship order gets put into place when you do go through a divorce, and that settlement agreement is what will dictate how much of your pension that you will receive. So it may say that you receive all of it. It may say that when you start collecting it, you have to give X percent of your spouse. The current value of that pension may have already been factored into the settlement agreement to what you give or receive. So that's a pretty specific question that we'd have to look at personally for you. All right, so another question is talking a lot about, we spoke about a lot of the negative impacts that being a female can have on your finances, but what are some of the positives? I love this question. I think as women, we're more prone to taking advice. That's why a lot of us are here today. We're willing to accept that we don't know everything. We're willing to seek out the answers. We're willing to educate ourselves. And that can be really, really prudent in creating a strong financial future. I also think that we can kind of stick to a plan really well, and not saying that men can't, right? But I think when we have goals, I think we can be very driven to achieve those goals. And working with an advisor to set up a list of attainable saving strategies or investment strategies, when you have that advice and it's put in place, it's really, I think, easy for us to follow that. So it's just figuring out what we don't know and then working with someone to create that list and then following through. All right, I'm just going to give it a couple more minutes here just to see if anything else comes through. Don't be shy. All right. Well, I don't see any other questions coming through, but what I will say is that, don't be afraid to ask for help. from your spouse, from a financial professional. Don't be afraid to get involved in your finances. You know, don't be afraid to reach out to a financial professional and schedule a meeting, right? You know, there are so many things involved, and hopefully this presentation didn't overwhelm you, but rather it educated you that there's so much that goes into your investment plan above and beyond just investing, right? There are so many things, whether it's emotions, whether it's pensions, whether it's family structure. You know, there's so much that comes into play, and a good financial professional is going to incorporate all that and help quarterback it all for you, right? So you don't have to do this alone, even though statistically we will be alone as females. You know, create a group, create a network, ask for help, and I'm here to help as much as I possibly can. Oh, I got asked about the charge for my service. Thank you for asking. So it all depends, right? So I can be compensated in two ways, right? I typically charge a 1% annual advisory fee on assets under management or assets that I manage on my behalf. There are some products like life insurance, long-term care, where the carriers pay a commission to me. Those products are excluded from my advisory fee, right? So your fee would kind of be dependent upon the investment products you have. There are investments that you may have now on your own or may have through me that have internal expenses. All of those internal expenses would be disclosed by me, you know, at or before the time of sale, before we engage in any sort of relationship. So you know exactly how I'm compensated on anything. You know exactly what you're paying to me. You know exactly what you're paying to the investment companies, which is something that right now, you know, is a difficult thing when you're managing your own investment, that a lot of the expenses that you're paying are hidden. So you don't know what you're paying. You don't know those internal costs of those mutual funds. And you get that prospectus that's supposed to be provided to you that now comes through as an email, and you click it and it's 100 pages long and it's overwhelming. You're supposed to read that to figure out what you're paying, and most people don't, right? So that's another reason to just kind of pay more attention to what you have going on to make sure none of those fees of what you have going on currently are hidden. Will my advice on investments be based on Citadel's offering or beyond? This is a really great question as well. So I am a dual employee. I'm employed by Citadel, but I'm also employed by CUSO Financial Services. Through CUSO Financial, I offer investments outside of the credit union. So everything that I manage for you, that I charge my fee on, is based on investments that are outside of the credit union. So stocks, bonds, mutual funds, managed portfolios, ETFs, life insurance, long-term care, the list goes on and on. So all of those investments are not bank products. They're not FDIC insured or NCUA insured. They're all investment products. A lot of times I help my clients manage their retirement plans and consolidate them if it's in their best interest. But I do, as part of my service and as part of my plan for my clients, is I help them manage their bank assets as well. Should we be using a high-yield savings or CDs based on what your needs are? I don't charge my fee on the assets that are not in investments, but they're definitely part of my plan. All right, I'm going to give it one more minute because these last couple of questions that came through were really, I think, helpful and informative. So I'll just give it 1 or 2 more minutes. We'll take it right to 1 o'clock here. Once again, I do want to thank you all for your patience and understanding with my video not working this morning. I promise I put myself together and made myself look my best for all of you. So hopefully I get to meet you all face to face or in a video meeting one-on-one one day. So thank you all so very much. I don't see anything else coming through. If you think of something after the presentation, or if you see the recording online again at a future date and some questions pop up, feel free to reach out. And thank you very much. Have a great day.